Greetings and good morning or good afternoon, and welcome to our webinar, Investing in Community Bank Capital Markets Debt. My name is Jeff Rigsby, and I'm the President and CEO of CB Resource, and I'll be both your host and moderator for today's session. First, I do want to take this opportunity to thank everyone for taking time out of their busy schedule to join us today. We know how busy you can be. We also indicated that the session will probably run no more than 45 minutes, and we're certainly committed to staying on schedule and respecting your time. For those of you that may not be familiar with Finance 500 and CB Resource, we're based in Irvine, California. We have joined forces through common ownership to serve the funding and bank performance and risk management needs of community banks across the country. Our combined companies serve the wholesale funding, investment banking, enterprise risk management, strategic and capital planning needs of over 2,000 community banks. Now I'd like to take this opportunity to introduce our two guest speakers today. First, I'd like to start with Chris Hogg. Chris is head of investment banking with Finance 500. Chris brings over 40 years of investment banking experience that have resulted in billions of dollars in funding, as well as the development of multiple products that have become industry standards. Prior to joining Finance 500, Chris spent the majority of his career with Goldman Sachs, where he was head of new product development and head of FIG capital markets. We're so glad to have you with us today, Chris. I also would like to introduce Long Wen. Long is the Executive Vice President and Chief Operating Officer of CB Resource. Prior to joining CB Resource, Long was the Executive Vice President, Chief Financial Officer of a community bank, about a $1.6 billion bank located here in Los Angeles. Long brings over 2 decades of experience as a Chief Financial Officer of community banks, and Long is also a CPA. Gentlemen, welcome. Welcome. You ready to get started?
We are.
Okay, just a quick little note to our attendees. Just to get the most out of the webinar, just want to let you know that there is an instant messaging capability that we do have. And so if you want to post any questions as we're going along, please feel free to do so. We will have a Q&A session at the end. I do want to let you know that the presentation materials are available upon request. You can simply request it through the reservation process of Zoom. You can send us direct emails or certainly call us on our toll-free number. I also want to let you know that this session will be recorded and that will be available as well. So we're breaking our session down today into 5 components. And what we're going to do is Chris is going to take lead and walk us through the leading 3 elements. So he's going to talk about, just what community bank capital market debt is. Why is it a worthy investment and how does that work? And also, what are the regulatory parameters? And then I've asked Long to come in and pretty much put on his CFO hat and talk to us in terms about investment guidelines and investment mechanics. So let's try to approach, so that Long can kind of share with us, well, from a policy perspective, this is what makes sense for community banks. And Chris is certainly going to take us through investment in debt securities 101, 102, 103, and 104. And so between these 2 subject matter experts, we intend for you to come away quite well informed. So with that, Chris, I'm going to turn things over to you and welcome.
Thank you. So let me make 5 points at the outset. Number 1, this is all way less complicated than you think. It's a very straightforward form of investment, and the way to make the investment is also very straightforward. And I hope that's going to come through with what we're saying here. Also, you'll be investing, if you decide to do so, in an industry that you are familiar with, which is a tremendous plus. And I would argue, third point, that is vastly superior, for example, to shared national credit investment or other types of investment of that kind, where you have far less knowledge of the credit in which you're becoming exposed to. You're going to hear both from Long and me that really the investment procedure in these transactions is very straightforward. And it's mostly common sense, frankly. You'll hear a lot of acronyms, you'll hear references to regulations, all that's true, but frankly, it's pretty straightforward. And finally, there's a plentiful supply of this product. So let's dig into here on page 3, what the main product is. So 98% of the debt that you would be looking at is subordinated debt. That qualifies as tier 2 capital, as I'm sure you know, for regulatory purposes. And it's mostly issued by the issuers at the holdco level and downstream as equity to the bank. So they get subordinated debt or tier 2 capital treatment at holdco, and they get on downstreaming tier 1 treatment for the proceeds at the bank level. There's been lots of it issued over the last 18 months. I would actually say that the market is on fire. It's close to accurate to say that, I think. We'll actually see this year, we'll touch on this a little bit in a slide or two, that the volume of issuance so far this year is well and truly on track to exceed last year. The average transaction size really varies. It can be quite big, as much as 50 million in size, but it can also be quite small as 5 million in size. And the investors love repeat issuance where they're comfortable with issuers' credits. Most of the deals that you will see will be private placements. There'll be Regulation D private placements. I'm going to touch on some detail about that a little later on. There are 3 principal investor groups in these transactions by community banks. You guys, other community banks, are frankly the most important investor group, but you're not the only one. Insurers also buy the product. There are a number of mid-sized insurance companies who are genuinely expert in community banks and eager to buy the instruments they issue. And finally, money managers, similar comment. There are a number of money managers who are also genuinely expert in this space and are also eager to get involved. Okay, now come some acronyms for you. So most of this product that's issued is called 10NC5 F2F. Don't get alarmed by that. All that means is generally the maturity is 10 years, hence the 10 years. The transaction is callable or redeemable at par after 5 years when it turns into a floating rate instrument. Why is that? Well, it's designed to get around the capital amortization rules that were imposed by the regulators for Tier 2 capital. Those rules say that Tier 2 capital amortizes for capital purposes at 20% a year once it's within 5 years of maturity. Okay, we all thought in designing this, and I was fairly involved in this. We'll go to the regulators and say, look, we'll flip this transaction from a fixed rate deal for the first 5 years using the 10 non-call 5 structure into a floating rate transaction. And it's expected that the floating rate exposure will be something of a rate step up. And so investors expect that after 5 years, the transaction will most likely be redeemed by the issuer. Doesn't have to be, but most likely it will be. And that means that the issuer gets essentially 5 years of non-amortizing Tier 2 capital. Of course, we can vary that theme. We can do 12 non-call 7. We can do 15 non-call 10, creating a maturity ladder with longer maturities. Okay, so now go to the next page, if you would, please, Jeff. So on page 4, I talk a little bit here about senior debt. It's the vast minority of issuance that's done by community banks, but I would argue it's not irrelevant. We are actually in the market right now with a transaction that is senior debt for a bank, and we'll soon be in the market with another that falls into that category. Senior debt is permitted under the Small Bank Holding Company Act for banks less than 3 billion in assets, and it too gets Tier 1 capital once it's downstreamed. It doesn't get Tier 2 at the holdco level, but usually that doesn't matter very much because most holdcos don't have a lot of assets or business in them. And the regulators look on the instrument favorably in terms of overall ratios, leverage ratio, and so forth. And of course, the hope and expectation would be because senior debt ranks higher than subordinated debt, it would have potentially a lower coupon. It also doesn't have capital amortization, so there are some structural advantages for it. All of that said, though, it's still the minority product versus subordinated debt. When I talk to my issuing clients, I always show both and weigh up pluses and minuses of each of them as they make their product selection. Next slide, if you don't mind, Jeff. Thank you. This is really just a term sheet that's meant to stack alongside each other those two products. I'll just take a trip down the left-hand side. You can issue subordinated debt at either the holding company or the bank level, mostly issued at the holding company level, so it can be downstreamed as equity. Most of the deals are private placements, as I told you, under Regulation D. All of the deals are unsecured. That's required by the regulators. And so those olden time bank holdco loans that are secured against bank stock, those actually don't really qualify for capital for regulatory purposes. This instrument certainly does, and the investors, all three of the investor groups we have found, fully understand that. It is indeed subordinate to all other holdco indebtedness, but most community banks don't have a lot of holdco indebtedness, so it's not subordinate to a lot. Again, only limited covenants are permitted by the regulators, and I mean very limited covenants, so it's not like a regular corporate bond in that sense. Generally speaking, the instrument is fixed rate until the call date in the case of subordinated debt, or until maturity in the case of senior. Mostly the coupons are semi-annual, but when the subordinated debt flips into floating, actually the coupon payment periods become quarterly. Of little consequence, I would argue, because again, the instrument is expected to be called. An important feature of these instruments, and Long is going to talk about this more than me, important feature of these instruments is that you can invest in them in either bond or loan format. It's proved to be a not insignificant feature for community banks. Ratings. I would say a third of the transactions are rated. If you are, as an issuer, less than $1 billion in size, a rating is kind of not cost effective. Even Egan-Jones ratings, which is more suitable for banks less than $1 billion in size, its rating charges are such that it's a little bit of a push to decide whether to get a rating or not. A rating is less important for bank investors. It's vital for insurance investors because of acronym warning, the NAIC, which requires them to post capital, the insurance company investors, against the instruments they buy. And the better an instrument is rated, the less capital they have to post. Okay, so next slide, Jeff, if you don't mind. So switching themes just a little bit here, this goes to volume and the nature of the market. Take a look at the slide on the left-hand side. As I said earlier, already volume so far this year is it's going to pass last year. And last year was a significant increase in volume versus prior years. I would say this market, mostly again a private placement market, really started getting legs in 2017, and it had sort of steady but not a huge amount of issuance, and then it took off. My view is a big reason that it took off is because of this cooperative capital concept that I talk about on the bottom left-hand side of this page. That is a relationship between both issuing and investing in your industry that has strengthened the industry and that has improved the profitability of its participants. And again, that will be a theme I think we'll touch on quite a lot during the rest of this presentation. Interestingly, rates have remained very attractive indeed. As you can see from the numbers here on the right-hand side, we've seen some slight softening in rates, frankly, but still in all, coupons have been at and below 4% for issuers. Still attractive relative to the regular loan product. The next page, Jeff, if that's okay. This next page I won't spend a ton of time on because I've kind of already touched on it, but it just gives you a little more detail in terms of coupons, for example, on those two boxes up there, transaction sizes. You can see the deals are not necessarily huge at all, and there's a lot of variation in them. So we'll skip over this one and move on, if that's all right, Jeff. Here's another interesting point. Of course, we want to say this because we're not one of the bigger houses. The market actually now has a broad range of broker-dealer participants in it. That I would argue for you as investors is a very positive thing because you're going to see from multiple sources, multiple opportunities to participate in community bank debt. And as I say, I think that's a healthy thing rather than it being concentrated perhaps in the hands of one or two houses. Next slide now, if that's okay. All right, so this next slide is really a slide that I've stolen from Jeff and Long. So it's only fair that I let Long speak to it a little bit. But I want to talk now a little bit about the why. Why is it that this market is so strong? And why is it that we predict that this market is going to continue to be strong? And we think a big reason for it is excess liquidity among community banks, which is the top graph on this page. And then the bottom graph on this page is NIM pressure. Long, please you jump in here as a CFO and tell us what you think about that environment.
Sure, and thank you, Chris, and good afternoon, everyone. if you had a chance to look at our previous material on excess liquidity and the post-pandemic conundrum, you would have been exposed to the massive liquidity that was impacting our industry. Obviously, we are all feeling the impact. And for example, looking at loan balances in our industry as of June 30th, 2019, that balance was approximately $9.6 trillion versus as of March 31st, 2021, which is $10.2 trillion. This represents a $600 billion growth in loans, or about 5.6%. However, total PPP loans as of March 31st, 2021 was approximately $800 billion. So when you strip out the PPP impact, loans or organic loans actually came down by about $200 billion over the last quarters. So with that in mind, when we look at deposits at the same time and comparing it to the loans, deposits was a roughly $13.1 trillion compared to March 30th, 2021 of $17.3 trillion. So that's an increase of about $4.2 trillion or 31% to the industry. So looking at this, $4.2 trillion, that's really astounding because organic growth has not really grown. In fact, if you remove PPP impact, it's actually come down. So now you're going to have to compete more aggressively with your neighbors, and you're going to have to give more concessions, either in the form of a rate, credit, or the term, and then you're exposed to interest rate risks. So strategically, what's going on right now is that loan demand is soft. And what are you going to do when PPP loans are repaid or forgiven? These PPP loans will now be converted to cash, and now you're faced with additional excess liquidity. And so looking at other investment alternatives is something to consider. With that in mind, Chris, I turn it back to you.
Thank you, sir. Great. Go to the next slide, Jeff, if you would. So let's just take a moment a little bit to talk about how you would see these investments coming to you as investors. And again, the vast majority are Regulation D private placements. Let me now, I promised I would, take a moment to describe to you what that means. It means that they are actually carefully prepared and structured private placements that are oriented towards institutional investors. Most all of you are qualified institutional buyers or accredited investors within the rubric of that Regulation D. We generally do not sell this product to retail investors. There are some exceptions to that, but generally that's not the case. So it's an institutional instrument. The actual procedure for doing these deals is pretty much shared among all the various broker-dealer participants. It's become pretty standard. And I would actually argue also very transparent. So starting on the left-hand side, preparation. I mentioned earlier, we have the discussions with the issuing client about whether they should do senior or subordinated debt. We then decide whether we should obtain a rating or not. I mentioned the challenges for smaller issuers. I would say as a general rule that deals of less than 15 million in size, usually we don't get a rating, but that varies somewhat. Then we get ready to put the deal into the market. And that involves the preparation really of three types of documents. The first is what we call the teaser. And that is generally a 1 to 2 page no names document that describes the issuer without naming the issuer, but with enough information, we hope, to get people interested in the transaction. We send that out pretty broadly among our clients. And I would be surprised if a lot of you haven't already received many a teaser from many a participant in the market. If the person receiving the teaser decides they are interested in potentially investing in the product, then we get people to sign an NDA, the non-disclosure agreement mentioned at the bottom of that box on the left. That NDA says two things. Number one, I as a potential investor promise to keep the information I'm going to receive confidential. And number two, I am either a QIB, a qualified institutional buyer, or an accredited investor. We call that the big boy representation. Once that document is signed, we give the investor access to a data room, just a website. And in that data room, we place the teaser, more importantly, the investor presentation, and the legal documents, the note and the note purchase agreement. The note and the note purchase agreement are standard documents, and pretty much it's almost like ISDA, not quite like ISDA for swaps, but they're pretty consistent from broker to broker and issuer to issuer. Let's talk about the IP, the investor presentation. The investor presentation really is only prepared from public information. We try very hard not to put private information in there. The investors don't really want it. And we don't really need it. And of course, our industry has the advantage of having a wealth of public information available. So the IP is visually attractive. It's actually prepared by business people and not lawyers. So it's actually kind of fun to read. And it's usually somewhere between 30 and 40 pages long. Jeff tries to make it shorter for me, but we usually end up about that kind of length. So once we put all those documents together, and honestly, that will take us 1 to sometimes 2 weeks to do. You know, we've done it a lot of times, so we know what needs to go in and so forth. Then we do the marketing. That also, we say 1 to 2 weeks, but it's usually 1 week. We send the teaser out as I've described, bring investors in, and spend time with them talking about the information in the data room. Often we will do one-on-one full presentations. You're certainly entitled to that as an investor. We actually have a policy of recording our management presentations and our deals, so you can easily access that recording whenever you want, and it's going to be in our data room. Then as we move to the right-hand side, closing. So closing, if you've decided you're interested, you will tell us or the other appropriate brokerage house, okay, we're interested, here's our order. Once that order is accepted, you're going to have your lawyers look at the legal documents and give us whatever comments they may have on those documents. And of course, it's our job to balance out the various comments we have on the legal documents. And so you can see why it's so important that they're standard in nature. Once that's all done, it usually takes only a couple of days, frankly, then there's an exchange of wire transfer information. The legal documents are signed and sent to you to keep for safekeeping, and the wire transfer information is exchanged, and then the wire transfers occur. Very straightforward, very standardized, and capable of being done quite quickly. So that's how it works. Let's go to the next slide now. And I want to go a little more quickly now because Long, I want to give you a chance to talk here, sir. So back on this whole cooperative capital thing, I would argue that a big reason why this product, this community bank capital product, is so popular is because it makes so much sense to both the issuer and to the investor. It makes sense to the issuer because the tax-deductible debt product, whether it be subordinated debt or senior debt, is far and away the least expensive source of capital for a community bank. I bet many of you remember the days when you had to issue common to raise capital, or you had to do pooled trust preferred, and we all know how that one ended up. Now we have a genuine capital market that is transparent to all involved, where real credit discussions occur about the issuers. So there is good reason for issuers to issue this product, on the one hand. On the other hand, as far as investors are concerned, there are also very good reasons, we would argue. And again, Long is going to deal with this much more than I will. But in an environment such as the one we're in now, particularly, this product has the advantage of an attractive yield, a relatively liquid secondary market, can be booked as a loan or a bond, and it's a familiar industry. I would argue, from a community bank perspective, one of the most important reasons to invest in a product of this kind is credit diversification, geographic diversification, and also diversification in terms of type of community bank business. Okay, next slide, which we're getting near the end of me, which is the regulatory environment. The regulatory environment for banks with less than $3 billion in assets is actually quite favorable in terms of investing. You'll see here on the top that there are really only concentration issues that apply. For larger banks, there's a 25% of total tier 1 capital limit. Not so for smaller banks. So it could be argued, we want to be safe about and careful about putting words in regulators' mouths, but it could be argued that it's a relatively benign regulatory environment in terms of investing in other community bank debt. Prudential limits apply, But as far as the regulators are concerned, they are not a huge challenge at all to you investing in this product area. And then just go to the next page quickly, Jeff, because frankly, it's kind of the same point that's already been made. I think the way that you should look at it from a regulatory perspective is, of course, you will need to be completely transparent with your regulators. You will find that they are quite familiar with this product from both points of view, issuance and investment. And I expect if you handle it in the way that Long is about to describe to you in a professional fashion, that you will find that your regulators will be helpful to you in investing in this product. So with that, let me pass things over to Long.
Thank you, Chris. And turning to slide 14 and looking at the investment policy, you should focus in on the purpose and objective of the investment. The purpose of the portfolio is to establish guidelines on how you should manage this process. The main objective of the bank is to meet the needs of the community it serves. Therefore, the investment portfolio should complement this objective along with your loan portfolio. The policy should designate a person, either investment officer or a CFO, to manage this risk and to also look at the credit versus the reward on the investment as well. But at the same time, keep in mind the compliance and regulatory issues as well for this investment. The other thing to make sure on your investment is to make sure that there is a stream of income that is consistent with your banking practice as well, so that it meets your ALM strategies, whether it's liquidity or return on investment. Next, moving to yields and targets, you should consider the yield you're willing to take to lock in this investment over a period of time. Now, keep in mind, does this make sense to have a 4% yielding asset, or would you rather pick up something else like a 5-year bond, which is earning about 69 basis points? Obviously, if you wanted to get a higher yield, you can actually go and consider a 10-year bond. That only earns about 118 basis points. So you're now exposed to credit and interest rate risk as well. I'm sorry, not credit risk, but interest rate risk. Looking at the proportion of the investments within your portfolio, how are you willing to invest and how much are you willing to invest? Obviously, if you want to invest in $10 million, you wouldn't want to put it all in one basket with one issuer. So generally, holding limits are subject to a limitation of 25% of capital for any one corporation and are considered prudent investment guidelines. As you can see below, this is an example. A sample of investment and holding limits, you should address the parameters within your investment policy. So in other words, make sure that your investment policy addresses corporate bonds and the size limit that you want to invest, either in the amount of assets or capital with your bank. The other thing to consider when investing is in geographical area, which Chris touched base on. Sometimes the issuer is an MDI bank, and so it makes sense. It makes it even more attractive. And so we are currently working with a bank right now that is also an issuer and an MDI bank as well. And lastly, on this page, make sure your investment has a permitted investment product. If the product is silent, you should consider putting it in. So for example, bankers acceptance, corporate bonds, you want to make sure your policy addresses this.
Hey, Long, excuse me, just 1 minute. Just if you could just modulate or just you're fading in and out just a tick, if you can.
Oh, sure.
Just
is that better?
Maybe increase the decibel level of pitch. Perfect. Thank you.
Is that better?
That's much better.
Perfect. Okay. Moving to the next slide, investment policy. I would suggest that you talk to your ALCO committee. Make sure you understand what you're getting yourself into. For example, when banks previously had excess liquidity or had CRE concentrations and they wanted to diversify, they got into shared national credits. Remember those credits? Now compare those SNC loans to corporate bonds. Knowing what you know now, what would you do? Would you consider SNCs or corporate bonds? Moving to personnel, make sure you have a talented person trained to understand the product and make sure that you have proper approval to move forward. Your authority should address what you can and cannot do, basically trying to protect your behind. Once you have the investment boarded, you should also review the credit, preferably on a semi-annual basis, and document the process. What are you looking for? and then how do you come up with that conclusion? Once you have this done, it's not a whole lot of work. So that's another part of the due diligence on this investment. On the other thing to consider is the secondary market. Basically, is there an exit strategy if you no longer want to do this? Are you boarding the loan as a trading, available for sale, or held to maturity? Generally, most bonds have a CUSIP, so it feels like an investment product, but it can also be booked as a loan. So I will go into further detail later in my slide, but for now, I want to turn it back to Chris to talk about Regulation D, private placement versus Public Rule 144A issuance. Chris?
Okay, thanks, Long. And Long, just on that speaking thing, you need to lean forward a bit. Then I think your microphone gets it better.
Is that better?
Yeah, that's good. So thank you, Long. There are three forms of instrument that could be relevant to you. The most relevant is the one we've talked about most, which is the Regulation D private placement. The vast majority of transactions, debt transactions issued by community banks will fall into that category simply because of legal expense and the fact that there is very little, if any, price sacrifice for doing a private transaction versus at the other end of the spectrum, doing an SEC registered deal. A fully SEC registered or public deal is really more the province for larger banks, frankly over 5 billion in size. For one smaller than that, there is some gradation of Rule 144A, which is kind of the middle spot between Reg D and SEC registered. But you should know this, Regulation D transactions after 6 months of seasoning actually turn into Rule 144A deals. So actually, Reg D is a subset of Rule 144A. So those are the three categories. The one that's most relevant to you is Reg D private placements. Back to you, Long.
Thank you, Chris. And moving to slide 16 on investment mechanics. You should perform a pre-purchase analysis similar to other investments. Normally, how the process works is if you're interested, you would normally get a presentation, investor presentation deck from your broker. If you want to move forward, a non-disclosure agreement is executed and you'll have access to confidential information, which Chris touched base earlier in his presentation. The other thing you want to consider is looking at the financial review, learning more about the issue itself, the management, history of the bank, how they make their money, and lastly, also their ability to service the debt and what they plan to do to use the proceeds for. Now, looking at concentration limits, are you heavily in one particular geographical area? Are you looking for banks that are similar to your operating platform or not? What are their products and services, and who are their customers? All of these are all good factors to consider when looking at the pre-purchase analysis. Now, turning to credit rating, is there something you need to, is that something in your policy? Some bonds are rated while others are not, because it's so costly and there's a maintenance fee behind that as well. So I would encourage you to talk to your ALCO committee and your regulator as well. Lastly, of course, is the reporting and safekeeping of the investment. This will fall into your investment products, so the process is very much the same. So it shouldn't be any different than any other investments that you normally do as well. And then I want to touch base on the last slide, which is the slide, the pros and cons of either recording this as a loan or an investment. So when you
advance one.
There you go, Jeff. Thank you. And then this is the last page I wanted to touch base on, is whether you should consider booking this as a loan or an investment. Obviously, if you want to put on your CCO hat to the left, you want to make sure that you review this in your loan policy if there's anything that talks about sub debts, and then get your credit department involved. Make sure that you have your underwriters look at this as well, because this is treated as a C&I loan. And the difference between, or the majority or the major difference between booking this as a loan versus an investment is that when you book this as a loan, you would tend to normally book a provision related to the loan as well. So you feel the impact of the provision for loan losses. And then, of course, later on, when you start to adopt CECL, if you haven't already done so, there shouldn't be a big change from making that true up because you have already put it in the loan as well. Now, the opposite to this whole thing is booking it as an investment. Obviously, you need to go through your investment guideline. You might need to make sure that it meets all of your investment needs as well. But the other thing too is that you don't have to book this, book an impaired loss, or you're booking this as par as well. But here's the biggest distinction between the two is that once you adopt CECL, you will more likely have to do a true up, if any, on this product as well. And when you do this true up, the impact is to your equity and not to your bottom line. So there's pros and cons to doing whether it's a loan or investment product. And this is one of the big key feature of that aspect as well.
Okay.
And with that,
Long, before you conclude, and I think you just addressed the question. We had a question posted that said, how do you determine if sub-debt placed in a loan or an investment portfolio? I think you've kind of covered that bit. Just to round out the question, if you were sitting in at your desk and you're looking at that pro-con decision, I'm going to book it as a loan, I'm going to book it as a security. Does anything come to mind in that, in your mind, as to what are the circumstances that might, at that point in time, have you go one direction or the other?
Yeah, that's a great question, Jeff. And I would look at my loan portfolio. So in other words, if I wanted to book this as a loan, and I'm heavy in CRE concentration, and I want to book a really good earning asset, I would record this as a loan because I can book it as a C&I loan. Obviously, I'm going to have to put some provisions through, but I also have the helpings of the credit underwriting team, and you have more eyes looking at this as well. On the opposite side to that is I could also book this as an investment, but then, I would also encourage banks out there to also get the credit department involved as well to see if they see anything, because, you want to make sure that the issuer has the ability to repay the debt as well and what they're using it for. So there's a lot of pros and cons. Obviously, when you're booking it as an investment, you don't have to book a provision for loan loss, but at some point, when you start to adopt that CECL adoption, you're going to have to true that up as well when you run it through your CECL model. And then you'll do that true up through equity and not through the P&L. So there's some pluses and minuses to both booking it as a loan or as an investment.
Okay. And I'd certainly encourage those that submitted that question, if that wasn't absolutely clear, please come back. I mean, I'm sure it was long, but please come back to us, and we encourage you to peel back the onion even further. So Long, I think you were probably kicking it to me.
Yeah. But before I wanted to send it back to you, Jeff, I just want to say that I've been a CFO for many, many banks, and obviously I've seen a lot of consolidation, and so have you, I'm sure, in one form or another. So right now, the product makes sense to invest in community banks, but think about this. I mean, you're helping the industry, you're actually helping your peers grow the bank. And at some point, you're going to be the one that's issuing that. You're the one that's going to be the issuer as well. And you're going to need banks to invest in that product as well. So give that some thought, because, in this world, it's a small community, and you might be the investor, but you might also be the issuer as well. So with that, I want to turn it back to you, Jeff.
Great. Thank you, Long. And thank you, Chris. Any of you that are used to our webinars, I always have an opinion about something. So just to share a couple of capstone thoughts, I think it's fair to say we all know that this excess liquidity issue is not going to go anywhere anytime soon. And we're all faced with the same challenge or conundrum where we've got margin compression, we've got a competitive lending environment. And for many of us that totally relied on our earning asset side of the house coming from lending, it's just gotten tougher and tougher. And with this record level of liquidity, I think it's fair to say it's even more difficult. So I think for the majority of community banks that maybe have been avoiding investment policies, or at least investing in securities, that's probably being revisited in a material way. There's certainly good resources to help that process to accommodate sensible securities investment. I think I could say, and I think you've probably heard the drumbeat here quality community bank debt securities, I think, should be a part of every and each bank security portfolio. There's a lot of different bond investments, and diversity is certainly important. But I think this industry has proven itself worthy in good times and bad to qualify as a worthy securities investment. From an investment policy standpoint, I'm just going to talk on behalf of some of my more interesting and maybe new age banking models. Is I would also encourage you to revisit your policy. Many banks that I work with kind of look at it and do tend to lean towards their comfort zone, either within their own state or a common business model. Our industry is changing, and I think it's fair to say this isn't our dad's industry anymore. We're seeing that specialty banks are consistently performing or outperforming in many cases. Non-traditional models have entered the market, and they're community banks as well, but they're either leveraging a capability or technology in a way we may or may not be familiar with. We're seeing larger footprints, and we're seeing a blurring of geographic lines. So as we look at due diligence and as we look at what constitutes a quality investment, recognize that these different business models may also be a form of diversification, as long as we're still satisfied that the fundamentals are sound, that the leadership is sound, that the business decisions they make is sound, that their business model makes sense. But it may not be just like ours, or it may not be what we've all come to know as our community banking model. And then lastly, I'll just reiterate what Long mentioned. I think our industry is consolidating, and a lot of banks want to maintain their independence. And we maintain our independence through continued above average earnings, if achieved, continue to grow, and continue to contribute to our communities in a way that we have for generations. And if we can leverage and support the industry through investing in ourselves, that just feels right to me. So those are just my closing thoughts. I do want to let you know there's no free lunch. So I hope you found this information useful, but this is our business, whether it's wanting support with policies, whether it's wanting support with seeking good investment, or issuing to increase your ability to grow or even reduce current debt loads. We do all those things. And I want to make sure that I close on that point, that we're here to serve you. And we hope you found this session useful and informative. I did answer one of the questions that came in. I know we might be butting up against a time issue, but I'll pause for just a moment and see if anybody else would like to post a question. I'll give you just a second. And while that's giving that second, I'll go ahead and put our contact information up. Okay. Oh, I see we have some, so bear with me. Okay. What is the ability to sell if you, and I'll put this to either one of you, Chris, this maybe you. What is the ability to sell if you want to exit the transaction? Who buys, and what is the secondary market?
That's probably a question for me. As the market has grown, so has its liquidity. This is not the Reg D market, the same as an SEC registered market. So it's not as liquid as that. And generally in the secondary market, if you seek to sell any of the instruments that you own, you will find that brokers like us will say, we will absolutely take that assignment on and sell on a best efforts basis. It may be that some of them, ourselves too potentially, might actually buy the instrument from you. But generally, the secondary market distribution is done on a best efforts basis. That works, let me assure you. People look at secondary trades in a very similar way to the way they're going to look at primary trades. And frankly, deals in the secondary market that are older may actually have a higher coupon than is the case right now. So it could prove to be attractive. So yes, there is a secondary market. It's real. It is not as big or liquid a market as, say, a publicly registered market, but it's still real.
Okay. Here's another one that's interesting. Once you book it, can you move it? i.e., can you book it as an investment, but then decide to book it as a loan? So I will punt this to both of you. Long, you might
Well, yeah, Jeff, that's an interesting question, and I'm stumped on this because normally you just want to book it either as one or the other. I don't see there's an issue with booking it as one or another, but I would ask the person is, you want to make sure you book it right the first time. I don't see there would be a need to move it back and forth, one way or another. But obviously, if you do go from investment to a loan, you can certainly book it as a loan, but then you got to go through your loan procedure as well to make sure that you board the loan. You then board, you put the proper provision through and making sure that that complies as well on the loan side.
Just to add to that, I would make the point that yes, it is possible to flip from one to the other. But for example, if you book it as a security in the initial instance and you're going to make it a loan, just like Long said, okay, well, I got to book now loan loss provision, against if I move it over. So you're going to have to comply with things like that. But my understanding is that yes, it is possible to do that, but probably best not to make a habit of it.
Okay. This next question is, what are the post-close reporting requirements to the investors?
Let me take a first shot at that. Not many is actually the answer. Issuers, by the way, do have to file a Form D with the SEC to say they've done these deals at their private placements. But as far as the investors are concerned, make no doubt about it, your regulators will obviously look at your portfolio, whether you book it as a loan or whether you book it as a security, and will want you to have preserved the investor presentation and the legal documents that you've signed and accumulated as part of the transaction, so that that will be available to them. They'll want to know what due diligence you have done in connection with the investment. So it would be wise, for example, to record when and how you had whatever discussion you had with the issuer in connection with making the transaction occur. But beyond that, and Long, please correct me, I don't think there's anything specific for this type of investment.
I think you're absolutely right, Chris.
And the caveat to that is we have seen situations where investors may request certain reports, but that's at the issuer's discretion as to whether or not they want to provide that.
I'll pile on to that quickly. Yes, that's true, mostly in industries other than the banking industry, because of course in the banking industry, we all know you're required to file those quarterly reports, so they're out there anyway. So generally that occurs. Let me make one thing clear to you all listening, and again, we're so grateful for you giving us your time. As Jeff said, this is our business. We are absolutely available to consult, to talk about formulating or amending your investment policies. We'd very much like to be involved in that. And one of the things, not just in terms of the, if you like, legal mumbo jumbo in putting it together, but also including in a changing industry such as the one we're in, and an industry where putting your money to work is increasingly a challenge, how you ought to formulate the various controls that you have. We'd be very interested in talking to any of you about that, should you consider that to be helpful.
Okay. Here's one just for a clarifying point. Just to confirm, did I hear you say if there is no ready secondary market or any market for the issue, those types should be recorded as a loan portfolio product in general? Is that a statement we made, or is there a?
I don't think we made.
Do you want me to say that again, or did you guys get that?
No, I got it. Let me go at it first. Thank you, though. No, I don't think we're saying of the products with which we're familiar that there is no secondary market for certain types of issuance. We would think the presumption for transactions of these Regulation D transactions are done to the market that is, so vibrant right now. You would expect them to have a degree of liquidity. So I don't think, sir or madam, in posing that question, that you should expect that that will push you towards booking them as a loan.
And just for clarification, Chris, an add-on to that question was, this is a separate question from the positive and differences between booking as a loan and a booking as a security. So just, if that helps from a clarity.
Yeah, I think I stick with my answer.
Okay, very good. Very good. Well, with that, I see on the clock on the wall, we're about ready to wrap. So on behalf of Chris, Long, myself, Finance 500 and CB Resource, we hope you found this session valuable. I would ask you to take a moment if you would, and whether you have anybody's email address, but please shoot me a note. Tell me what you liked or what you didn't like or what you'd like to see more of from us. And I always want to close on the fact that we're here to support your abilities to optimize your performance, both in terms of from a business standpoint and from a risk standpoint. And we hope when you're thinking about investment banking, fixed income solutions, wholesale funding, or our array of professional services like ERM, strategic planning, and capital planning, you keep us top of mind and give us the shot. Thank you for your time, and we look forward to seeing you at our next webinar.
Thank you.
Thank you, everyone.
Thank you.